All right, let's jump right into today's explainer. We've got some wild mid-July 2026 market shifts to talk about, tracking everything from a massive momentum collapse all the way over to a brewing AI infrastructure debate. There's a ton of fascinating data to unpack here, so let's get right to it. Here is a quick look at where we're headed. We're going to cover the great market rotation, the widening AI divide, some really strange broken market anomalies, that massive payments mega merger, a bit of geopolitics and aerospace, and finally, what's on the upcoming horizon. Starting off with Section 1, the great market rotation, where we're seeing capital sprint away from momentum stocks. Check this out. The Invesco S&P 500 Momentum ETF just took a brutal 7.1% dive this July. And the hardest hit names in this basket? We're talking Corning, Teradyne, SanDisk, and Intel. They are all down over 26% just this month. They're aggressively testing that critical 50-day moving average. Now, you can think of that moving average as a sort of psychological floor for investors. The real fear here? If this ETF breaks that support line and falls through the floor, this pullback could very easily snowball into a much broader, much uglier market rout. And the contrast in the market right now is just wild. Capital is running away from the highly volatile semiconductor space. The PHLX semiconductor index is down 13% in July, and it's looking for a safe place to hide. And where is it going? Right into the famous 5 big tech giants, Apple, Amazon, Alphabet, Meta, and Microsoft. The logic behind this structural shift is actually pretty fascinating. Investors are betting that if memory chip prices drop because of this sell-off, these big tech giants can keep up their massive AI infrastructure spending, but at a way lower cost. It makes them the ultimate defensive haven right now. So, what does this all mean? Well, this massive structural rotation of capital is pushing Apple to the brink of an absolutely unprecedented, historic $5 trillion market cap. $5 trillion. Just to put that into perspective for you, that is roughly the entire GDP of Japan. It really is a staggering testament to just how aggressively investors are prioritizing perceived safety and cash flow at this very moment. Moving right along to Section 2, the AI divide. This is all about the hardware reality versus what's being called software psychosis. Let's unpack the violent clash happening within the tech sector itself. On one side, you have the hardware reality, which is an absolute, undeniable boom. TSMC just posted a massive 77% profit boost, hitting a record $22 billion, driven purely by high-performance computing demand. ASML is seeing record orders too. But flip to the other side, and we have the software psychosis. IBM shares just plunged 25%. It's stoking this very real fear that the desperate urgency to adopt AI is forcing companies to literally cannibalize their traditional IT budgets just to keep up. To give you some context on this software fear, tech analyst at Zitron is sounding a massive alarm, warning about a potential Lehman Brothers of AI scenario. He's predicting that an ultimate collapse of OpenAI could trigger this violent, punishing effect across the entire market, leaving hyperscalers, those massive tech giants building the data centers, sitting on mountains of wasted capex. Now, this is a stark contrast to legendary investor Howard Marks, who recently upgraded his view on AI, calling its autonomy and context retention historically unprecedented. It is a massive intellectual divide right now. Just let this number sink in for a second. $852 billion. If you want to know why the bears are sounding the alarm, look no further than this staggering figure. OpenAI is currently projected to burn $852 billion by the year 2030. Right now, they're eating up over half of the $50 billion global compute spend. The fundamental question the market is agonizing over is, will the software revenue ever actually materialize to justify this kind of historic cash burn? All right, Section 3. Broken markets and anomalies. Let's look at how structural constraints and extreme retail fervor are literally breaking the fundamental rules of finance. So the law of one price is a fundamental rule. It states that identical assets should trade at the exact same price. But history is full of these wild arbitrage failures, where investors try to pocket risk-free profits from price gaps and just fail completely. Back in March 2000, 3Com's remaining stake in Palm implied an 80% higher valuation, but arbitrage failed because the pros literally couldn't borrow Palm shares to short them. We saw it happen again with the Grayscale Bitcoin Trust, swinging from a 100% premium in 2017 to a 45% discount by 2023. And that history leads us right up to today's bizarre pricing anomalies. Today, we're seeing SK Hynix US ADRs, which are essentially certificates that let US investors trade foreign shares locally, commanding a massive 50% premium over their native shares in Seoul. Why? Simply because they can't be converted yet. The demand to get in on the AI trade is so intense that buyers are completely ignoring the actual underlying value of the asset. We saw a similar thing when the Destiny Tech 100 fund surged way above its net asset value strictly because of retail demand for its private SpaceX holdings, and what happened next? It subsequently collapsed by 60%. The core takeaway from all this data is crystal clear. Do not attempt to trade the gap. When you see violations of the law of one price like this, they aren't easy, risk-free arbitrage opportunities. You should view them as a definitive red flag. It's a loud, unavoidable signal of localized overexcitement and imminent investor exhaustion. Let's pivot away from market mechanics and move over to Section 4, the payments mega merger between Stripe and PayPal. We are looking at a massive $53 billion buyout lifeline proposed for PayPal. Stripe, along with Advent International, has reportedly bid $60.50 per share to take the struggling legacy payments giant private. Honestly, when you think about how much the fintech landscape has evolved, it is pretty wild to see the relatively young upstart throwing a lifeline to the old legacy giant of the internet. This potential deal really breaks down perfectly into 3 diagnostic pillars. First, there's the infrastructure. Stripe's merchant payment tech is generally viewed as strictly superior, which would heavily aid PayPal's merchant retention. Second is valuation. At 11.5 times earnings per share, this is considered a highly fair valuation for a business that's currently staring down negative earnings growth. And third, the structure. PayPal stock has been stuck in no man's land for years now. Taking the company private gives new leadership the structural cover they need to execute a painful multi-year turnaround safely away from the punishing glare of the public equity markets. Zooming out to the global stage, we have Section 5, Geopolitics and Aerospace. We're looking at some major pressures and real-world physical divergences here. Looking at the global map right now, we are tracking 2 immediate real-world pressures on trade and energy. In the Middle East, as U.S. strikes on Iran escalate, military experts are warning that keeping the Strait of Hormuz open would require a massive troop deployment, and that tension is keeping crude oil prices elevated near $80.31 a barrel. Meanwhile, down in South America, the U.S. is hitting Brazil with 25% tariffs on certain goods following a trade investigation. In response, Brazilian President Lula is threatening to activate economic reciprocity laws. These are 2 highly localized flashpoints for sure, but they have massive global supply chain implications. At the same time, we're seeing some fascinating divergences in the aerospace sector. United Airlines just posted a record Q2 revenue of $17.7 billion. But despite that incredible top line, they are warning that jet fuel costs could balloon by nearly $6 billion this year, which might force them to trim capacity in Q4. It's a classic margin squeeze. On the flip side, you have SpaceX. Their private stock has actually dipped below its $135 IPO price. However, they have a massively exciting sentiment booster on deck, the critical 13th test of Starship, which aims to validate reusability and fundamentally slash orbital payload costs. So you have 2 aerospace giants facing completely different atmospheric pressures. And that brings us to our final section, the upcoming horizon. Let's talk about the catalysts and data drops coming our way. The market is facing some major impending hurdles over the next few weeks. We've got a heavy slate of corporate earnings dropping, led by big names like Netflix, United Health, Abbott, and State Street. But we also have critical macro data coming in. June retail sales are forecast to rise 0.3% month over month, while pending home sales are expected to show a 0.3% drop. You better believe this data will be aggressively parsed by investors. They're looking for signs of consumer exhaustion, basically trying to figure out if regular people are finally closing their wallets in the face of all these economic pressures. But it's not just corporate and macro data on the horizon. The cultural economy is bringing its own heavy hitters. Christopher Nolan's highly anticipated film, The Odyssey, is projecting a massive $125 million domestic opening. And look, this isn't just movie trivia. This single film is actually acting as the financial linchpin for IMAX's projected record-smashing $1.4 billion global box office year. It is going to be a massive real-world test of discretionary consumer spending in the entertainment sector. Which leaves us with the ultimate question for you to ponder as we wrap up today's explainer. As this huge wave of earnings, macro data, and cultural revenue rolls in, will it confirm the big fade we are currently seeing in momentum stocks, or is it going to ignite an entirely new rotation rally? Keep a close eye on those data drops, because they hold the answer.